If you want to grow wealth but hate stock picking, you're not alone. ETFs let you own a broad market slice without guessing what will move next. This video lays out a simple, repeatable plan for beginners. This is an ETF guide for beginners, episode 112. It uses a core set of funds, small automatic steps, and a clear progress check. ETFs are like baskets of stocks and bonds. You buy one ETF and you get hundreds of companies at once, with lower fees than many mutual funds. The goal here is consistency over speed. Set a plan, put money in regularly, and forget the rest until the numbers tell you how you're doing. First, define your goal and how much risk you're willing to take. Are you saving for a big purchase in 5 years or building retirement money over decades? Your time frame shapes your choices. Next, pick a core set of broad ETFs to cover the market. A simple core could be a U.S. total stock market ETF, an international stock ETF, and a bond ETF. These three give you broad exposure with one purchase each. For example, you might use VTI for the U.S. stock market, VXUS for international stocks, and BND for bonds. There are other options in different regions, but the idea stays the same. Broad exposure at low cost. Your asset allocation should match your risk tolerance. A common starting point for many beginners is 60% stocks and 40% bonds, but you can shift toward 80-20 or 50-50 depending on comfort. The important part is to pick a ratio you can stick with. Now choose a broker and set up automatic contributions. Look for no account minimums, free trades, and simple tools to automate deposits. The goal is to turn investing into a monthly habit, not a yearly chore. Build a core satellite plan. The core is your 3 broad ETFs that stay in place most of the time. The satellite is a small tilt, maybe a small cap or tech-focused ETF, that you add or swap occasionally to reflect your interests or new information. If you're starting with, say, $300 a month, a simple split would be 60% into U.S. stocks, 30% into international stocks, and 10% into bonds. That translates to $180 in VTI, $90 in VXUS, and $30 in BND each month. You can adjust the exact funds later, but the idea is to automate the plan. Set up automatic contributions each month. Don't try to time the market. Automating takes emotion out of investing and reduces the risk of missing a month. Rebalance your portfolio once a year. A simple rule is to bring each asset class back to its target percentage. Rebalancing costs are usually small, and staying close to your plan prevents drift into too much risk. Be mindful of taxes. In many places, putting the core ETFs in a tax-advantaged account is smart. If you're investing in a taxable account, you can still use ETFs, but you may owe taxes on dividends or capital gains when you sell. Keep costs low. Focus on funds with low expense ratios and high liquidity. Check the fund's tracking error, which shows how closely it tracks its index. The smaller the difference, the better. Avoid common beginner mistakes. Don't chase hot funds or try to pick the exact top performers. Don't ignore fees, and don't squeeze your portfolio into a plan that feels too complicated or stressful. A practical checklist to start today. Decide your goal and time frame. Pick 3 core ETFs that cover the market, 2 or 3 different brokers you could use, and a monthly contribution amount you can commit to for at least 6 months. Create your own routine. On the first of every month, check that your automatic deposit kicked in. Then confirm your allocations are still in line with your target. That's enough ritual to keep you honest without turning investing into a full-time job. What about diversification beyond ETFs? You can add small satellite bets if you want, but keep them tiny and simple. A small allocation to a sector-focused ETF or a region you're curious about can be fine, but don't lose sight of your core. If you have a future you want to fund, remember time is on your side. The sooner you start, the more compounding can work for you. You don't need perfect knowledge to win long-term. You just need consistency. About setting expectations. Broad stock markets can rise over time, but they will also have down years. The plan is to stay invested through downturns, not to chase quick wins. Your goal is steady growth, not a fireworks show. How to choose exact funds in the real world? Look for 3 things: very low cost, broad exposure, and easy trading. The exact fund names aren't as important as the principles behind them. A quick, concrete example using numbers. Suppose you have $1,000 saved. You decide to use a 60-40 split with 3 funds, 600 in a U.S. total stock ETF, 400 in a bond ETF. You'd place orders for $600 of VTI and $400 of BND. then set up automatic deposits to fill those positions each month. Over time, you'll drift if you don't rebalance, so the annual check matters. If you want some extra fuel, you can tilt slightly toward international exposure or add a small cap tilt through a satellite fund. Do this only after you're comfortable with the core plan and your monthly habit is established. What to do when the market drops? Stay calm. You're buying more shares when prices are lower, which is exactly what you want in a long-term plan. If you keep contributions steady, your average cost per share tends to improve over time. What about self-control? You're anchoring your behavior to a routine, not to market opinions. The goal is to reduce the chance of making a big mistake in a bad month. As you grow, you can refine the plan. You might increase your monthly contribution or switch to slightly more international exposure. Keep the core the same and adjust only the size of the tilt. The mindset you want is boring but reliable. If you can treat investing as a monthly bill, you'll build wealth without drama. That's the beauty of this approach. One more practical tip. Track your progress in a simple log. Record your starting balance, your monthly contribution, and the ending balance after each month. The numbers rarely lie, and the act of writing them down helps you stay honest. Another note on education. You don't need to become an expert in market cycles. You just need to know how your plan works and why it's reasonable. You can learn a little more over time, but the core habit should stay stable. If you encounter a tricky year, keep with the plan. Markets will ebb and flow, but your routine can stay intact. You're building a habit that pays off with time. Now you have a practical, beginner-friendly plan for investing in ETFs. It's not flashy, it's steady. It's a toolkit you can use for months, then years, and it scales as you grow. Before we finish, a quick recap of the steps. Define your goal and risk. Pick 3 core ETFs, set up automatic contributions, rebalance yearly, and watch costs. If you stick with those steps, you're on the path to steady growth. If you're not sure which funds to pick, start with broad, low-cost options. Look for funds with expense ratios under 0.115% and high liquidity. If you can't decide, ask for help from a trusted advisor or use a robo-advisor that aligns with your plan. To tighten the plan even more, you could add a small monthly check-in. A 5-minute review can help you stay on track if you've had a rough month or a big change in your life. Finally, a quick note on patience. These plans don't work overnight. The power is in consistent, repeatable actions over years, not in a single big move. If you're ready to start today, take one action. Open a brokerage account that supports automatic investing. Pick a realistic monthly amount and commit for 6 months. Then come back with an update after your first month. Thank you for watching. If you found this guide useful, please like, subscribe, and share it with someone who wants a straightforward path to investing. Subscribe for more simple, practical money tips. I post new videos every week with a calm, boring approach to growing wealth. Comment below with your first ETF pick or your biggest hesitation about starting. Please like, subscribe, and leave a comment. I read every note and reply when I can.